Welcome, everybody. It's great to do another regional press briefing. We always enjoy talking to you because we talk to you. We also talk to everybody in our district. So this morning, what I'm going to do is I'm going to discuss conditions in the national economy. And I'll talk a little bit about monetary policy. Then I'm going to focus on regional economic conditions with particular attention on the question of the day, which is whether recent college graduates are finding good jobs or not. As always, what I have to say reflects my own views and not necessarily those of the Federal Open Market Committee or the Federal Reserve System. So I'd like to begin by taking stock of where we are at the moment. Then I'll address my expectations for the performance of the economy over the remainder of 2013 and into 2014. Since the end of the Great Recession in the middle of 2009, we've had 15 consecutive quarters of positive growth in real GDP. However, the average annual growth rate over that period has just been 2.1% annualized. And although the unemployment rates declined by about 2.5 percentage points from the peak of 10% in October of 2009, much of this decline has been due to the fact that the labor force participation rate has fallen by 1.5 percentage points over that period. You recall that discouraged workers who no longer are actively looking at work are counted as not participating in the labor market, and so they're not counted as unemployed. If you look at an alternative measure, the employment to population ratio, which is not influenced by changes in the number of discouraged workers, there has been a much more limited improvement in labor market conditions. Job loss rates have fallen, but hiring rates remain very depressed at low levels. So taken together, I think it's fair to say that the labor market still cannot be characterized as healthy. Numerous indicators, including the behavior of labor compensation and households' assessment of labor market conditions, they're all consistent with the view that there remains a great deal of slack in the U.S. economy. That being said, I do see evidence of improved underlying fundamentals for the private sector of the U.S. economy. Key measures of household leverage have declined, and we're now at the lowest levels they've been at in more than a decade. Household net worth, expressed as a percentage of disposable income, has increased back to the average level of the last decade. That reflects a general trend of rising equity and home prices over the last 6 months. Banks are beginning to ease credit standards after a period of prolonged tightness. As a result, we're actually seeing a fairly typical cyclical recovery, a delayed recovery, but a cyclical recovery in consumer spending on durable goods. For example, lightweight motor vehicle sales were at a 15.3 million annual rate in the month of May, not very far from the 16.1 million sales rate that we saw in 2007. Similarly, after 5 years in which housing production has been well below what's consistent with underlying demographic trends, it now appears we've worked off the excess supply of housing that we built up during the boom years. Housing starts and sales are now on a clear upward trend, and a widely followed national home price index is up about 12% over the last year. Indeed, anecdotal reports suggest that one of the reasons why we're seeing a fairly rapid rate of home price increases is due to the lack of inventory of homes for sale. So that's the good news. Unfortunately, the improvements in consumer spending on durable goods and housing, though, are not yet showing through in terms of the overall GDP growth rate, and that's due to the significant headwinds that we still face. First, federal fiscal policy has become quite contractionary recently. Estimates from the Congressional Budget Office, the CBO, indicate that this fiscal restraint is on the order of 1.75 percentage points of potential GDP this year. But if we look back all the way to 1960 and ask ourselves, how often has this occurred? There's only 2 previous episodes of fiscal contraction on this order of magnitude, 1969 and 1987. And those both occurred when the economy was on a much more solid footing than it is today. Second, we have the fact that the euro area is experiencing a protracted recession, and growth in some of the largest emerging economies is slowing. This has resulted in a very sharp slowing in U.S. export growth, with an associated slowing in manufacturing output and employment growth in the manufacturing sector. So I'm still where I was before. I see the economy as being in a tug of war between fiscal drag on one hand and underlying fundamental improvements on the other, with a great deal of uncertainty over which force is actually going to be the more dominant one over the near term. We see this tug of war clearly in the monthly employment data. So if you take the last 2 months, April and May, average monthly gain in employment for the private sector has been about 175,000 per month. If we look at manufacturing, which is affected by trade, and we look at the federal government, we've seen declines of 20,000 per month. So I think the resulting uncertainty, I believe, is an important contributing factor behind why we're seeing still relatively sluggish business fixed investment spending, because people aren't really sure how this tug of war is going to play out. My best guess is that for all of 2003, when we look at growth on a fourth quarter over fourth quarter basis, it's going to be about the same as what it's been since the end of the recession. But I believe that when we look a little bit beyond that into 2014, there's a good chance that growth will actually start to pick up. The private sector of the economy should continue to heal, and the amount of fiscal drag should begin to subside. I also think that there are some prospects that our major trading partners will actually grow faster as we look out into 2014. So if we get that combination of events and the uncertainty about the outlook lessens, then I think we'll also see some strengthening in business fixed investment. Now, if you think about this tug of war analogy, I think it's also useful in terms of looking at the inflation outlook. As is well known, total inflation is measured by the PCE, Personal Consumption Expenditure Deflator. We had our most recent report this morning. Has slowed sharply over the past year. It's now running well below the FOMC's express goal of 2%. We're running about 1% year over year on total personal consumption expenditure inflation, 1.1% on core personal consumption expenditure deflation. Now, much of this slowing in total inflation is due to declining energy prices resulting from the slowdown in global growth. But if we look at core inflation, so inflation excluding food and energy, we also see a sharp slowdown there. And if we look at what's really driving that, what we see is that some of this is due to a slowing in the rate of increases of non-food and non-energy goods. This is probably due in part to the softening in global demand for goods, and probably a little bit due to the fact that the dollar has appreciated modestly since the middle of 2011. When we look a little bit deeper into the service sector, what we see is the rate of increase in prices of medical services and non-market services. Non-market services are things that don't have explicit prices that the BLS has to impute prices to. A lot of this is financial services. They've shown very little price inflation recently. In contrast, if we look at the rate of increase in prices for other non-energy services, they've been pretty stable. So the slowdown in services really seems to be confined to a couple of relatively small segments. This is a little bit different than the case in 2010 when the slowing in inflation was broader across both core goods and core services. The other difference from 2010 is while we've had some decline in inflation expectations measured by the five-year forward for TIPS, it's less pronounced than what we saw in 2010. So my best guess is that we'll actually see inflation pick up a little bit over the next couple years, moving back towards the Federal Reserve's 2% target. Now, as always, I think there's substantial uncertainty surrounding this forecast. There's always the possibility that we'll see some sort of unforeseen shock that will affect the economic outlook. So we're going to be monitoring U.S. and global economic conditions very carefully, and we're going to adjust our views about the likely path for growth, inflation, the unemployment rate, accordingly in response to the new information. Now, at its meeting last week, the FOMC decided to continue its accommodative monetary policy stance. It reaffirmed its expectation that the current low range for the federal funds rate target will be appropriate at least as long as the unemployment remains above 6.5%, so long as inflation and inflation expectations remain well behaved. Now, it's important in thinking about the 6.5% unemployment rate. That's a threshold, not a trigger. The FOMC also maintained its purchases of $40 billion per month in agency mortgage-backed securities and $45 billion per month in Treasury securities, with a stated goal of promoting a substantial improvement in the labor market outlook in the context of price stability. In its statement, the FOMC said it may vary the pace of purchases as economic conditions evolve. And as Chairman Bernanke stated in his press conference following the meeting, if the economic data over the next year turns out to be broadly consistent with the outlooks that the FOMC sees as most likely, which is roughly similar to the outlook that I laid out here today, the FOMC anticipates that it would be appropriate to begin to moderate the pace of asset purchases later this year. Under such a central scenario, Subsequent reductions might occur in measured steps through the first half of 2014, and the end of purchases might occur around the middle of 2014. Under this scenario, at the time that the asset purchase came to end, the unemployment rate likely would be around 7%, and the economy's momentum would be strengthening, supporting further robust job gains in the future. Now, in thinking about this, I think there are a few points that really deserve emphasis. First, the FOMC's policy depends on the progress we make towards our objectives. And this means that policy, including the pace of asset purchases, depends on the economic outlook, not on the calendar. The scenario that I outlined earlier is just one possible outcome. Economic circumstances could diverge significantly from the FOMC's expectations. For example, if labor market conditions and the economy's growth momentum were less favorable than the FOMC's outlook, and this has actually happened quite often in the last few years, I would expect that the asset purchases would continue at a higher pace for longer. Second, even if we get the central scenario that has been sketched out for you, and the pace of purchases were subsequently reduced in the future, it still would be the case as long as the Fed is buying assets, they're adding monetary policy accommodation, not tightening monetary policy. And that's a really key point. As the FOMC adds to its stock of securities, this should continue to put downward pressure on long-term interest rates, making monetary policy more accommodative. Third, I think it's also important to stress the Federal Reserve would like to keep most of these assets on its balance sheet for a long time. As Chairman Bernanke noted in his press conference last week, a strong majority of FOMC participants no longer favor selling agency MBS securities during the monetary policy normalization process. This implies a bigger balance sheet for a longer period of time, which provides additional accommodation today and continuing support for mortgage markets going forward. Fourth, even under the central scenario, which is highly uncertain, a rise in short-term rates is likely to be a long ways off. Not only will it take a considerable time to reach the FOMC's 6.5% unemployment rate threshold, but it's also the fact that the FOMC could wait considerably longer before actually raising short-term interest rates. The fact that inflation is coming in well below the FOMC's 2% objective is relevant here. Most FOMC participants currently do not expect short-term rates to begin to rise until 2015. Now, some commentators have interpreted the recent shift in the market-implied path of short-term rates as indicating that market participants now expect the first increase in the federal funds rate to come considerably earlier than previously thought. Now, setting aside whether this is the right way to interpret recent price moves, let me emphasize that such an expectation would be quite out of sync with both the FOMC statements and the expectations of most FOMC participants. So now let me turn to the regional economy, the focus of our presentations today. Our last briefing on the regional economy took place at a difficult time, soon after Superstorm Sandy. While economic life has returned to normal across most of the metro areas, some of the hardest hit areas are still struggling to recover and rebuild. In fact, just a couple blocks from here, South Street Seaport Business District is still far from business as usual. And there are many neighborhoods across the metropolitan region, from the low-lying coastal areas of New Jersey to Brooklyn, Queens, and Long Island, Staten Island, and Southern Connecticut, that are still getting back on their feet. One encouraging sign, though, is if we look at the broader regional economy, it has shown remarkable resilience. It's growing, and it's adding jobs at a reasonably good pace. Moreover, the rebuilding effort actually appears to be giving a bit of boost to the job market in industries such as construction. Now, as we've discussed before, the New York Fed produces economic activity indices to help us keep track of the performance of New York State, New York City, and New Jersey. And based on these measures, New York City has continued to grow strongly. New Jersey's economy has seen some pickup in growth since the beginning of this year. However, growth in New York State as a whole has slowed, and Puerto Rico's economy is not faring well at all. The activity index produced by the Government Development Bank for Puerto Rico shows that the island's economy has yet to show signs of bottoming out. With respect to the job market, the job situation has varied somewhat across the region. Improvement has generally been broad-based, with New York City and Long Island doing particularly well, though Puerto Rico continues to weaken. Both Connecticut and New Jersey have recently been growing employment in line with the national average thus far in 2013. Unemployment rates across the region are roughly equivalent to the national rate, with the exception of the very high rate that has characterized Puerto Rico's labor market for some time. Housing continues to be a focus of our regional monitoring efforts, and home prices in our region appear to have bottomed and are starting to rise. And our economists will elaborate on some of these points this morning. Now, the special topic of today's press briefing is to look at how well recent college graduates are faring in the job market, both nationally and here in our region. A college education represents an important investment, as we all know, in one's human capital. What we mean by human capital is the knowledge and skills that people acquire. Historically, it's been pretty clear that those who've invested in a college education have tended to earn a sizable economic return from that education over their lifetimes. And the benefits of having people be college educated go well beyond, that is good for the individual. If you look at regions with higher concentrations of college graduates, they tend to be more innovative, they tend to have higher living standards, and they tend to experience more rapid economic growth. So it's good for everybody. So college education plays an important role in helping individuals prosper, as well as strengthening the broader economy. Now, more recently, though, rising costs, increasing student debt, and widespread reports of recent college graduates not being able to find good jobs have raised some questions about whether going to college is still a good investment or not. In fact, some of our own research, including material that we discussed at our last press briefing, has shown a dramatic increase in student loan debt over the past decade. So in today's briefing, we're going to look at a different question. We're going to take a close look at the question of just how weak is today's labor market for new college graduates. And what we're going to do is we're going to put their recent experience into context using some hard data. It's important for us to undertake this kind of analysis because it will show newly minted graduates always take some time to transition into the labor market and find jobs that fully utilize their education. And young people with college degrees still fare far better than those without, as we will see. At the same time, with the sluggish job recovery from the recession, it's clear that the transition of recent graduates into the labor market is taking longer than it typically does. And the fact is they have experienced higher unemployment and greater underemployment than in years past. Still, while times have gotten tough for recent graduates, we shouldn't be hasty in concluding that getting a college education won't help people find good jobs. The evidence is broadly consistent with the idea that a college education is still a very good thing to have.